What if I told you the world's best stock market just had its worst day ever? This is Kenya News Update today. Coming up, you'll discover why South Korea's historic rally is now a roller coaster of fear and greed, and what it means for your money. The benchmark Kospi index plunged a staggering 12% on Wednesday. That's its largest single-day drop on record. But here's the twist. The very next day, it rocketed back up nearly 10% for its best day since 2008. This is the wild volatility gripping the world's top-performing market from 2025. Meet the two giants driving this chaos. SK Hynix and Samsung Electronics. Together, they make up about one-third of the entire Kospi's market value. SK Hynix skyrocketed 274% last year. Samsung surged 125%. When they rise, the whole market soars, but when they fall, the entire index gets dragged down. And that's exactly what's happening now. But here's what nobody's talking about: the hidden leverage fueling these insane swings. South Korea has a massive base of retail investors and an active derivatives market. Market veteran Daniel Yu from Yuanta Securities explains the chaos. He says, "This is just too much of the leverage trading that's affecting the market. We had a huge amount of margin calls for retail investors, so they just dumped it, and then it went back up again." It's a panic sell-off followed by a desperate buyback, all amplified by borrowed money. And then something shocking happened. A global trigger lit the fuse. The escalating war in the Middle East sent oil prices surging, creating a global risk-off mood. But experts say Korea is a special case, an outlier. Jason HSU from Radiant Global Advisors points to the extreme concentration. He told CNBC, "Korea is a bit of an outlier." The Kospi's heavy concentration in a handful of technology stocks meant that market moves tend to be magnified. It's a perfect storm. Global fear meets a market built on just two tech pillars. The Kospi Volatility Index, which measures fear, surged 27% to hit a record high during the sell-off. Even after calming slightly, it remains at record high levels. The market isn't just moving, it's screaming in panic. Here's the part that will blow your mind. This isn't just about stocks. It's a warning about concentration risk in a fragile world. When your entire market depends on the memory chip cycle and global oil prices, you're on a knife's edge. One geopolitical shock, one shift in tech sentiment, and billions can vanish in hours. The implications are massive for global investors. Some see this as a healthy correction after a historic bubble. Others see a broken market structure, where a few stocks hold a nation's wealth hostage. The controversy is clear. Is this just normal volatility for a high-flying market? Or is it a sign of a much deeper systemic problem waiting to explode? But if two companies can swing an entire country's market by 12% in a day, what does that say about the stability of modern investing? Do you think this extreme concentration is a recipe for disaster or just the price of high returns? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking global business news that impacts you.